So imagine committing this, just a simple paperwork error today, and that error gives the federal government the affirmative legal right to audit your corporate finances in, like, the year 2045.
Yeah, it sounds like an exaggeration, but it really isn't.
Right. Because normally we think of tax liabilities as having an expiration date, you know?
Yeah.
You file your return, 3 or maybe 6 years go by, and the window closes. You think you're safe.
Exactly. You think
There
you're
you
safe.
go.
But hidden inside this notoriously complex architecture of IRS Form 5471 is this statutory trapdoor.
Yeah.
It basically freezes the statute of limitations forever.
Forever. Which is terrifying. And the IRS doesn't view international compliance through the same lens as domestic filing, do they?
No, not at all. I mean, when money crosses borders, the government's visibility drops to near zero. So Form 5471 is essentially their radar system.
And if you fail to turn that radar on properly.
They penalize you by keeping your tax year open indefinitely.
Wow. Okay, welcome to the deep dive. For you listening, whether you're prepping for a massive corporate structuring meeting, managing an international portfolio, or, you're just insanely curious about the hidden gears of international finance, we have a really critical mission today.
We definitely do.
We are demystifying the categories of filers for Form 5471. Specifically, we're going to tear down the overview and dig deeply into the mechanics of categories 1, 2, and 3.
And we have a pretty formidable stack of sources anchoring this discussion today.
Yeah, we're looking at the official IRS Form 5471 instructions, revised December 2025. We're decoding some incredibly dense Treasury regulations, specifically Treasury Regulation 1.6046-1.
Right.
And most revealingly, I think, we are pulling back the curtain on internal IRS penalty practice units.
Which is fascinating. These are the literal training manuals the IRS uses to teach their agents how to drop the hammer on non-compliant taxpayers.
Exactly. Okay, let's unpack this. The penalty unit in our stack is explicitly titled Failure to File the Form 5471, and it contains that specific directive regarding the infinite statute of limitations.
Yeah, the legal mechanism there is tied to Section 6038.
Right.
The penalty clock for assessing and collecting those penalties, it doesn't even begin to pick until a substantially complete Form 5471 is filed.
So I want to make sure we define substantially complete here, because my instinct says that means, you gave it your best effort, you filled out the entity's name, gave them the balance sheet, maybe you missed a minor supplementary schedule, but you fundamentally complied.
I would not rely on that instinct.
No.
Based on the penalty units, the IRS definition of substantially complete is pretty ruthless.
How ruthless are we talking?
Well, the training material for IRS agents instructs them to verify the fact of filing as step 1. The manual literally directs the agent to review the U.S. Person's Form 5471 for any schedule required by their specific filing category that was not prepared.
Wow.
Yeah. The text explicitly states that if the form does not contain all required schedules, Section 6038 is not substantially complied with.
Let's translate the severity of that for you listening. You could have like a 100-page tax return, right?
Easily.
And you could attach a Form 5471 that includes a perfect income statement and a flawless balance sheet. But if you were supposed to check the box for Category 1 and you forgot to attach Schedule P detailing previously taxed earnings...
The IRS treats the entire form as if it basically doesn't exist. For the purpose of the statute of limitations, at least, the year is open.
That liability is just open-ended.
Completely. An auditor reviewing a 2025 return in the year 2038 could uncover that missing Schedule P, declare the original filing incomplete, and assess penalties. And not just for the form, they could potentially adjust related tax items.
That is insane, and it's the foundational reason why we cannot simply guess at these categories.
Right, you can't guess. The category dictates the required schedules. If you fail to map your categories perfectly, you inevitably fail to file the correct schedules.
Which triggers the infinite statute of limitations.
Exactly.
That structural reality means we really have to understand the architecture of the form itself before we even look at the specific threshold math. Like, why did the IRS build it this way?
That's a great question.
Why not just have one master form that every multinational fills out from top to bottom?
It really comes down to the diverse nature of international ownership. The IRS is trying to monitor everything from, a U.S. citizen holding a minority stake in a French bakery, all the way to a massive domestic conglomerate restructuring a chain of intellectual property holding companies in Bermuda.
Right, those are completely different universes.
Exactly. A one-size-fits-all form would either be woefully inadequate for the conglomerate or paralyzingly burdensome for the minority investor in the bakery.
So Form 5471 is modular.
Yes. The categories act as filters, tailoring the reporting burden to the taxpayer's specific level of control and access to information.
I look at the instructions and I kind of see it like a complex architectural blueprint.
That's a good way to look at it.
Like, the category you fall into is your security clearance badge. It determines which rooms in the building you are forced to enter.
Yeah, that's spot on.
So if you hold a Category 1 badge, you have to unlock Schedule J. If you hold a Category 2 badge, you don't. The instructions state clearly that schedules like E, I1, J, P, and Q are completed strictly by category.
And the blueprint analogy works really well when you factor in how the IRS handles overlapping clearances.
What do you mean by overlapping?
Well, often a U.S. person doesn't just hold one category status. They might hold several simultaneously.
Oh, okay.
The instructions mandate that if you're described in more than one category, you don't duplicate the information, but you must synthesize the requirements.
So combining the security clearances.
Right. So if you're the sole owner of a controlled foreign corporation, you might be classified as both a Category 4 and a Category 5 Cap A filer.
And what does that mean practically?
In that scenario, the instructions compel you to complete all 6 main pages of Form 5471, plus separate schedules E, G1, H, H1, I1, J, M, P, Q, and R.
Wow. That is a massive administrative lift. And building on that blueprint analogy, the sources reveal a mapping maze that goes far beyond just one person and one company.
Oh, absolutely.
We're looking at a system where the exact same foreign entity can have multiple U.S. owners, right? And every single one of those U.S. owners might have a completely different category status for the identical foreign corporation.
Yeah, this is the everyday reality of corporate structuring. Consider a foreign corporation with 3 different U.S. stakeholders.
Okay, let's map this out.
Stakeholder A might be a Category 3 filer because they acquired a block of stock in November. Stakeholder B might be a Category 2 filer because they're an officer of the U.S. company that made an acquisition.
And stakeholder C.
They might be a Category 4 filer because they've maintained a controlling interest all year. They are all looking at the exact same German robotics firm, but their compliance burdens are entirely distinct.
So if you're the tax director for a U.S. multinational, you can't just print out the corporate organizational chart on December 31st and use that to assign your Form 5471 categories.
No. A static end-of-year snapshot is completely useless here.
Just totally inadequate.
Actually, a static snapshot is actively dangerous. Relying on year-end balances guarantees you will miss transactional categories.
Because things move throughout the year.
Right. The regulations and penalty units point toward the absolute necessity of maintaining a continuous transaction log. You must systematically document every single event during the year where a U.S. person crosses a key threshold.
Give me an example of an event.
If ownership creeps from 9% to 10% on a random Tuesday in March, that must be logged. If a U.S. citizen is appointed to the board of directors in July, that must be logged.
So categories are determined by chronologically mapping these specific events.
Exactly. Applying constructive ownership rules to each one and identifying which U.S. persons were dragged across the statutory thresholds.
That level of chronological tracking, that requires an immense amount of internal coordination. You're talking about legal, HR, and finance, all feeding into a central compliance database in real time.
Without that internal infrastructure, you're flying blind. You will inevitably miss an event-driven category trigger.
Okay, let's take that concept of the chronological transaction log and apply it to the actual categories.
Let's do it.
The instructions start sequentially with Category 1, but when I cross-reference the Form 5471 instructions with the IRS Penalty Practice Unit, I hit a massive contradiction.
Ah, yes. The ghost category.
Right, because the penalty unit states plainly, Category 1, relating to certain shareholders of foreign personal holding companies, was repealed in 2004. It's gone.
Completely gone.
But the December 2025 form instructions dedicate pages of dense text to dictating exactly how a Category 1 filer must report. How do we reconcile a category that was repealed 2 decades ago with a massive compliance burden today?
We have to look at the legislative history to understand this ghost in the machine. Prior to 2004, Category 1 was indeed used for foreign personal holding companies.
Which was what, exactly?
It was a specific type of entity the IRS used to prevent individuals from hiding passive income, like dividends and interest, offshore. But Congress eliminated the foreign personal holding company regime in 2004 because it overlapped clumsily with the broader Subpart F rules.
Makes sense to clean that up.
Right. But when they repealed the regime, The IRS didn't renumber the entire Form 5471. They just left Category 1 blank. It just sat dormant.
Like a placeholder waiting for a new crisis.
Exactly. And the crisis arrived with the 2017 Tax Cuts and Jobs Act. The U.S. government shifted from a worldwide taxation system toward a territorial system.
Okay.
And as part of that transition, Congress enacted Section 965, imposing a one-time mandatory repatriation tax on the accumulated untaxed foreign earnings of U.S.-owned foreign corporations.
So suddenly there's this massive new pool of earnings to track.
Yes, the IRS had a critical need to track highly specific earnings and the shareholders attached to them. So instead of rewriting the whole form, they resurrected the dormant Category 1.
That makes the current definition highly specific.
It does.
The sources define a current Category 1 filer conceptually as a U.S. shareholder of a foreign corporation that was a Section 965 specified foreign corporation, or SFC, at any time during the foreign corporation's tax year.
Right.
But let's break down the jargon here. When we talk about these accumulated earnings being tracked by Category 1, we are talking about E&P earnings and profits.
Yes, E&P.
And I want to make sure you, the listener, understand that E&P is not just a standard GAAP accounting concept. It is a parallel accounting universe.
It really is. Tax E&P is fundamentally distinct from the net income you see on a standard financial statement prepared under generally accepted accounting principles.
Because GAAP is designed to show investors the economic performance of a company, right?
Exactly. But tax E&P is a highly specific statutory concept designed to measure a corporation's true economic ability to pay dividends to its shareholders.
Give me an example of how they diverge, because if a corporate controller tries to just pull the GAAP retained earnings to satisfy a Category 1 filing, they're going to fail the substantial compliance test.
Definitely. Consider depreciation. Under GAAP, a company might use accelerated depreciation to aggressively reduce the book value of an asset in its early years, right?
Right, which reduces net income.
But for tax E&P purposes, the IRS often requires you to use the alternative depreciation system, which stretches the depreciation over a much longer straight-line period.
Oh, I see.
So in year 1, your GAAP net income might be artificially low, but your tax E&P remains much higher. E&P also requires adjustments for things like tax-exempt income, which increases your ability to pay a dividend, even if it's not taxable, or non-deductible expenses, which reduce your ability to pay a dividend.
So when the 2017 transition tax hit, the IRS essentially took a snapshot of this parallel E&P universe for these specified foreign corporations, and they taxed it.
Exactly.
Now, for practitioners working today, years after that transition event, Category 1 can feel like a historical artifact, but the instructions make it clear this is a residual requirement that continues to haunt taxpayers.
The requirement lingers because the life cycle of those transition tax earnings is not over yet. Still, the instructions mandate that a Category 1 filer must continue to report as long as 2 potential conditions exist. The first condition is if the SFC still has accumulated E&P related to Section 965, that must be reported on Schedule J.
Wait, so if the company hasn't actually distributed that specific pool of money yet, it just sits on the balance sheet, and you have to keep filing Category 1 year after year to tell the IRS, yes, that money is still sitting there.
Yes. The IRS wants continuous visibility until that specific E&P pool is drained to zero.
Wow. Okay, what's the second condition?
The second condition keeps the requirement alive even longer. You must file as long as the filer has previously taxed E&P related to Section 965 that is reportable on Schedule P.
Let's unpack previously taxed E&P, because you paid the tax on this money back in 2017 or 2018 when the mandatory repatriation happened. You already paid the bill. Why does the IRS still care so deeply about tracking it?
Because the U.S. tax system generally dictates that you shouldn't be taxed twice on the same corporate earnings. Once the earnings are taxed under Section 965, they become previously taxed earnings and profits, or PTEP.
PTEP.
When the foreign corporation eventually distributes that actual cash to the U.S. shareholder, the distribution of PTEP is generally tax-free.
Okay, that makes sense.
So the IRS requires Schedule P to track the exact categorization and movement of that PTEP. That way, when the distribution happens, you can prove it shouldn't be taxed again.
Ah, so it's protective for the taxpayer in a way.
Yes, but equally importantly, it's so the IRS can track the associated foreign currency exchange gains or losses that occur between the time the tax was assessed and the time the cash was actually distributed.
It is an ongoing forensic accounting exercise. Now, the instructions don't just leave it at a blanket category 1, they slice it into subcategories, 1A, 1B, and 1C.
They do.
Looking at the history here, it seems the IRS realized they cast the net too wide with the initial transition tax rules. Minority investors were getting crushed by reporting requirements for companies they couldn't control.
It was a huge problem.
The sources point to IRS Revenue Procedure 2019-40 as the vehicle that provided specific relief. How does that relief manifest in Category 1B?
Well, the creation of Category 1B was a direct response to a massive practical impossibility. A Category 1B filer is defined as an unrelated Section 958, subsection A, U.S. shareholder of a foreign-controlled SFC.
Okay, let's isolate the critical elements there.
Right, so unrelated means the U.S. person does not have the type of familial or corporate control relationship with the foreign entity that Section 954, subsection D, paragraph 3 describes.
So say I'm a U.S. private equity fund and I buy 12% of a massive manufacturing firm in Vietnam. That 12% makes me a U.S. shareholder under the threshold rules. But the other 88% is owned by a Vietnamese family. I am completely unrelated to them, and they fundamentally control the company. I have zero power to force the Vietnamese family to restructure their local accounting to calculate U.S. tax EMP.
Exactly. The IRS recognized that the U.S. private equity fund in your example was being forced to declare complex financial metrics under the threat of massive penalties without any legal mechanism to compel the foreign-controlled entity to produce the data.
It's basically a catch-22.
It was. So Revenue Procedure 2019-40 established a safe harbor. It allows Category 1B filers a significantly reduced reporting burden.
How reduce?
They're generally exempted from completing the most rigorous schedules detailing the underlying financial mechanics of the foreign corporation, provided they aren't trying to claim certain foreign tax credits that would require that granular data to substantiate.
That feels like a rare moment of IRS pragmatism.
Very rare.
What about Category 1C?
Category 1C addresses a different kind of trap, phantom ownership. A Category 1C filer is a related constructive U.S. shareholder of a foreign-controlled SFC.
Related constructive, meaning what?
This applies to a person who does not own a single share of stock, directly or indirectly within the meaning of Section 958, subsection A. Their ownership is 100% constructive attribution. The tax code pretends they own it because of their relationship to the actual owner.
Right, and we are going to dive deeply into the horrors of constructive ownership in Section 5. But for the context of Category 1C, this subcategory exists to provide a tailored, reduced reporting framework for someone who is related to the entity but only owns it through attribution.
Exactly. It limits their exposure to the schedules that are relevant to their specific attributed tax reality rather than treating them like a direct controlling owner.
So Category 1 is this resurrected ghost hunting down specific pockets of transition tax E&P with relief valves built in for minority and constructive owners.
That's a great summary.
That brings us to Category 2. If Category 1 traps you with old earnings, Category 2 traps you for simply doing your job.
Oh yeah, Category 2 is brutal.
I look at this as the officer-director trap. It operates on an entirely different trigger than the pure ownership categories.
It does. Category 2 shifts the compliance burden away from the entity making the investment and places it squarely on the shoulders of the individual human beings running the target or the subsidiary.
Let that sink in.
It applies to a U.S. citizen or resident who is an officer or director of a foreign corporation in which a U.S. person acquires stock that meets specific 10% ownership thresholds.
The 10% threshold is the tripwire. The sources specify this means acquiring 10% or more of the total value of the foreign corporation's stock, or are 10% or more of the total combined voting power of all classes of stock with voting rights.
Correct.
But the most alarming part of Category 2 is the disconnect between the action and the liability. An individual must file this deeply invasive, highly penalized Form 54721, even if they never buy a single share of stock themselves.
Yes. The IRS utilizes U.S. officers and directors as an early warning radar system.
A radar system.
Yeah, they know that corporate entities can be opaque and transactions can be buried in complex consolidations. By placing a personal legal obligation on the U.S. citizens sitting in the boardroom, the IRS creates a secondary reporting channel that is extremely difficult for a corporation to hide.
Let's build a concrete narrative around this to show you how dangerous it is. Imagine a massive U.S. parent company, let's call them Global Megacorp.
Okay, global megacorp.
Global Megacorp decides to execute a strategic acquisition. They buy a 15% stake in an emerging robotics firm based in Munich, Germany. Global Megacorp makes the purchase. They wire the money. They hold the shares.
So global megacorp has triggered a filing requirement for themselves.
Naturally.
But the ripple effect immediately hits the individuals. Imagine you are a U.S. citizen living in Munich, and you serve as the chief financial officer of that German robotics firm.
Okay, so I'm the CFO. I had nothing to do with Global Megacorp's decision. I didn't orchestrate the acquisition. I just work there.
Doesn't matter. Because a U.S. person, global megacorp, acquired more than 10% of the company where you are an officer, your status lights up the switchboard at the IRS.
Wait, so I personally, on my individual Form 1040 tax return, now have an affirmative legal obligation to attach a Form 5471 reporting Global Megacorp's acquisition of the company I work for.
Yes, you personally.
And if I don't?
If you fail to do so, the IRS assesses the penalty against you, the individual. You become personally liable for the Section 6038 penalties, and your individual statute of limitations for that tax year remains frozen until you substantially comply.
That is legitimately terrifying. You are collateral damage in a corporate transaction happening above your head.
Collateral damage is the perfect term for it.
Is there any mechanism for the CFO, in our example, to escape this? The instructions have to provide some kind of relief so that every U.S. expat executive isn't spending tens of thousands of dollars on personal tax preparation for corporate actions?
The instructions do contain an escape hatch, but it is highly conditional.
What are the conditions?
A Category 2 filer is relieved of the filing requirement if two distinct conditions are met immediately after the reportable stock acquisition. First, 3 or fewer U.S. persons must own 95% or more in value of the outstanding stock of the foreign corporation.
So the ownership structure of the German robotics firm has to be incredibly tight post-acquisition. It has to be closely held by just a few U.S. players.
Right. That eliminates the exception for widely held or highly fragmented foreign entities.
Okay, so what's the second condition?
The second condition is where the true risk lies for the individual. The U.S. person who actually made the acquisition, in our case Global Megacorp, must file a return as a Category 3 filer and provide all the information that the Category 2 officer or director would have been required to report.
Wait, look closely at the architecture of that exception. The IRS is saying, we will let the CFO off the hook, but only if Global Megacorp does its job perfectly.
Exactly.
My personal compliance is entirely tethered to the competence of Global Megacorp's tax department.
It creates a massive silo problem. If you're that CFO, you cannot simply assume Global Megacorp is filing correctly.
Because if they mess up,
If Global Megacorp's tax team misinterprets a threshold or forgets to attach a schedule, rendering their Form 5471 not substantially complete, your exception evaporates retroactively.
wow.
The IRS will look at the transaction, see that Global Megacorp failed, and pivot immediately to penalize the Category 2 officers and directors who relied on that failed corporate filing.
Which brings us right back to the necessity of the chronological transaction log, but viewed from a different angle. It's not just the corporation mapping its own liabilities. Individuals serving on foreign boards must demand written confirmation from corporate acquirers that a Category 3 filing was successfully executed.
Absolutely. In fact, prudent practitioners often advise Category 2 clients to file the Form 5471 themselves, providing whatever identifying information they can, rather than relying blindly on the corporate exception.
Better safe than sorry.
Filing a protective, perhaps partially complete form with a disclosure statement is generally a stronger defense against the infinite statute of limitations than hoping a third-party corporation filed flawlessly.
That dynamic is the perfect bridge to Category 3. If Category 2 is for the terrified executive sitting in the boardroom watching the acquisition happen, Category 3 is for the U.S. person actually sitting across the table signing the term sheet.
Right.
Category 3 is fundamentally event-driven.
Category 3 is triggered by structural movements. The sources outline a specific list of events: acquisitions of stock, dispositions of stock, reorganizations, or changes in proportional interests that hit the statutory thresholds.
What exactly counts as a change in proportional interest?
Well, a change in proportional interest often occurs when the company issues new shares to someone else, diluting your stake, or maybe they retire shares, which artificially inflates your percentage without you buying anything.
The Treasury regulations provide incredibly dense mathematical examples for how these thresholds operate. I want to walk through the incremental math of Category 3 because it's not as simple as just tell us when you own 10%.
No, it is decidedly not that simple.
The rules create a system of incremental reporting blocks. Let's look at the conceptual framework established in Section 6046, Cap A, and specifically Example 3 from Treasury Regulation 1.6046-1.
Example 3 perfectly illustrates the trap of incremental accumulation. The trigger isn't just a static 10% line. The trigger is acquiring 10% or more, or are acquiring an additional 10% or more since a return was last required.
Let's ground that in a timeline so you can picture it. We have an investor, Person X. On September 15th, Person X acquires 8% of the outstanding stock of M Corporation. Does that September transaction trigger a Category 3 filing requirement?
No. An 8% acquisition falls below the initial 10% threshold. The IRS radar does not register the event. Person X has no Category 3 liability for the September transaction.
Okay, so they hold their 8% in silence. But the example continues. 6 weeks later, on November 1st of the same tax year, Person X goes back to the market and acquires an additional 4% of the outstanding stock of M Corporation. What is the regulatory consequence of that November purchase?
This is where the incremental math catches the taxpayer. On November 1st, Person X didn't buy 10%. They only got 4%.
Right.
However, the regulations require you to look back to the last time a return was required. Since no return was ever required, we look at the total accumulation. Person X has now acquired an additional 10% or more since a return was last filed. Their total is 12%.
So it crosses the line.
Therefore, the 4% transaction in November acts as the trigger. Category 3 is activated.
I think of this math like a corporate loyalty punch card. You don't get a free coffee, or in this case, a massive IRS filing obligation every time you buy a coffee. You only get it when you punch the 10th hole.
The punch card analogy is mathematically accurate. Let's extend the timeline to show how the blocks work in practice.
Okay, let's keep going.
Person X files their Category 3 form for the year they hit 12%. They are compliant. Over the next 3 years, they engage in small incremental purchases. Year 2, they buy 3%. Year 3, they buy 4%. Year 4, they buy 2%.
So they've gone from 12% to 21% ownership. Do any of those individual purchases trigger a new Category 3 form?
Based on the punch card logic, no. They acquired 3%, then 4%, then 2%. That is a total addition of 9% since their last filing at 12%. They haven't filled up the 10-hole punch card yet.
Exactly correct. Under the framework of the regulation, they have no new Category 3 filing for those years, despite actively increasing their ownership.
But the moment they buy just 1% more in year 5,
taking their cumulative addition since the last filing to 10%.
the punch card is full. That tiny 1% transaction triggers a massive new Category 3 filing requirement for the entire entity.
This proves why a static year-end balance sheet is a compliance death sentence.
Absolutely.
If your tax team only looks at the fact that you own 22% at the end of year 5, they have no idea if you bought that 22% 10 years ago, or if you cross an incremental 10% block in March of the current year.
You cannot determine Category 3 status without looking backward through the chronological transaction log to find the last time a return was filed and measuring the exact percentage change since that specific date.
The tracking burden is immense, and it leads to a critical realization regarding the lifespan of these filings. Because Category 3 is tied to these specific event-driven threshold crossings, a Category 3 filing is inherently a one-time obligation attached to the tax year of the event.
That's right.
So if I trigger the punch card in 2024, I am a Category 3 filer for 2024. Assuming I make 0 trades in 2025, my Category 3 obligation vanishes for that year. I am no longer a Category 3 filer.
Correct. The event is isolated. However, the ownership you acquire during that event does not vanish. This is where the IRS forces a seamless transition into the ongoing reporting categories. When you acquire 12% of the stock, triggering Category 3, you are now holding 12% of the stock on an ongoing basis. By holding more than 10%, you meet the definition of a U.S. shareholder.
And as a U.S. shareholder, assuming the foreign entity is a controlled foreign corporation, I immediately transition into a Category 5 filer for 2024, and I will remain a Category 5 filer for 2025, 2026, and every subsequent year I hold that stock.
The structural flow is deliberate. Category 3 is the net that catches the movement. Categories 4 and 5 are the cages that hold you once you arrive.
That is a vivid metaphor.
If your acquisition pushes you over 50% control, you trigger Category 3 for the movement, and you seamlessly become a Category 4 controlling U.S. shareholder for the ongoing duration of your control.
Okay, we have covered the logic of direct acquisitions. You sign the term sheet, you buy the stock, you trigger the math. That is highly complex, but it is fundamentally rational. You took an action.
Right, you did something.
Now, we must descend into what I consider the most treacherous area of international tax law: the web of constructive ownership and downward attribution. What happens when you cross these thresholds and acquire phantom ownership without doing anything at all?
Constructive ownership is the concept that the IRS can treat you as owning stock that someone else actually holds.
Just conceptually, that is so aggressive.
It is. The legal theory is that certain relationships, familial, partnership, or corporate, create an economic unity. If a parent corporation owns a subsidiary, the IRS attributes the subsidiary's assets upward to the parent. Upward attribution is intuitive.
Sure.
Downward attribution is where the system fractures.
To understand the fracture, we have to look at the legislative earthquake that occurred during the 2017 Tax Cuts and Jobs Act. Our sources point to a specific seismic shift: the repeal of Section 958, subsection B, paragraph 4. Why did Congress repeal this paragraph? What was the loophole they were trying to close?
The repeal was driven by a desire to combat base erosion and corporate inversions.
Okay, corporate inversions, let's define that.
For years, multinational corporations engaged in inversion transactions. Think of the classic structures used by companies like Burger King when it merged with Tim Hortons. A U.S. corporation would restructure so that a new foreign entity became the ultimate parent company.
They flipped the structure, so the U.S. company was no longer the boss. The U.S. company became a subsidiary of a foreign parent located in a lower tax jurisdiction.
Exactly. And once that foreign parent was established, it would create other foreign subsidiaries, sister companies, to the U.S. entity.
Okay, I see where this is going.
The foreign parent would then aggressively strip profits out of the U.S. subsidiary by charging it massive royalties for intellectual property held by the foreign sister companies, or by loading the U.S. subsidiary with debt and charging high interest.
So the profits moved from the high-tax U.S. to the low-tax foreign sister companies.
Right.
And before 2017, the IRS had a massive blind spot regarding those foreign sister companies. Because of Section 958, subsection B, paragraph 4, downward attribution from a foreign person to a U.S. person was expressly turned off.
That was the protective barrier. The U.S. subsidiary was not treated as owning the stock of its foreign parent or its foreign sister companies.
So the IRS couldn't reach them?
The IRS could not use the U.S. subsidiary to force reporting or impose Subpart F income inclusions on the foreign sister companies. The foreign parent's empire was effectively shielded from the U.S. subsidiary's tax return.
So Congress, in its infinite wisdom, decided to burn the barrier to the ground. They repealed the paragraph. Downward attribution was turned on. Stock owned by a foreign parent can now be attributed downward to a U.S. subsidiary. Let's trace the chaotic mechanics of this using example 16 from the IRS training deck.
Example 16 outlines a classic V structure. At the top of the V, we have a foreign parent company. Let's call them FP. FP owns 100% of a foreign subsidiary, FS1. That's the left side of the V.
Okay, FP to FS1.
FP also owns 100% of a domestic U.S. subsidiary, USS. That's the right side of the V.
So before the 2017 repeal, USS and FS1 were just sister companies operating in their own lanes. USS had no relationship to FS1 from a U.S. tax reporting perspective.
None at all.
But post-repeal, the downward attribution rules trigger a chain reaction. First, because USS is owned by FP, the tax code attributes everything FP owns downward into USS. Therefore, the domestic sub, USS, is considered to constructively own the stock of its foreign parent, FP.
And through FP, the attribution flows back down the other side of the V. USS is considered to constructively own 100% of the foreign sister company, FS1.
USS is now treated as owning 100% of FS1. This triggers two immediate catastrophic classifications. First, because USS is a domestic entity that now constructively owns more than 10% of a foreign corporation, USS suddenly becomes a U.S. shareholder.
Right.
Second, because a U.S. shareholder now owns more than 50% of FS1, FS1 is instantly classified as a controlled foreign corporation, a CFC.
This is the exact unintended consequence that has panicked the tax industry. U.S. entities that were never U.S. shareholders before are suddenly dragged into the filing gap. And foreign corporations that were never CFCs are suddenly classified as CFCs purely because of downward attribution to a U.S. affiliate.
Let's analyze the operational reality for the chief financial officer of USS. The CFO is running a domestic manufacturing plant in Ohio. Their foreign parent company in London decides to buy a software firm in India.
Okay.
USS in Ohio didn't fund the purchase. USS doesn't use the software. USS has zero operational interaction with the Indian firm. But because of downward attribution, USS is now a U.S. shareholder of a newly minted Indian CFC. USS now has an affirmative legal obligation to file Form 5471 for a sister company it has absolutely no operational control over.
And if the CFO in Ohio fails to file that form, the infinite statute of limitations opens on the U.S. manufacturing plant's tax return.
Unbelievable.
The IRS recognized that this dynamic was practically unworkable. In many cases, foreign parent companies actively refuse to provide their U.S. subsidiaries with the granular financial data of their other global operations.
Of course they do. Why would they share that?
Exactly. The U.S. subsidiary is trapped between a federal compliance mandate and a foreign parent's data blockade.
So how does the CFO in Ohio avoid having their corporate veil pierced by this phantom ownership? Looking at the instructions, the IRS attempts to offer an escape hatch through the constructive ownership exception. Does this exception solve the downward attribution crisis?
It solves some problems, but it severely fails. Example 16. To qualify for the standard constructive ownership exception, you must meet very strict conditions. First, you must not own a direct interest in the foreign corporation. Your ownership must be purely constructive.
USS meets that requirement. They don't own direct shares in the Indian software firm.
But the second condition is where the trap snaps shut again. The instructions state you are only accepted if you are required to file because of constructive ownership from another U.S. person.
Wait, let's read that carefully. From another U.S. person. In our downward attribution example, the attribution came from the foreign parent in London.
The standard exception hinges on the IRS receiving the data from someone in the U.S. tax net. The IRS is fundamentally pragmatic here. They need the financial picture of the foreign subsidiary. If a U.S. parent company is already supplying a complete Form 5471 for the foreign subsidiary, forcing a lower-tier U.S. subsidiary to file the exact same data is redundant. The exception allows the lower-tier U.S. entity to rely on a higher-tier U.S. entity's filing.
But in example 16, there is no higher-tier U.S. entity. The attribution flows from a foreign parent who is not filing a Form 5471. Because the attribution comes from a foreign person, the standard constructive ownership exception is legally inaccessible to USS.
USS is fully exposed. This structural failure in the regulations is what finally forced the IRS to issue Revenue Procedure 2019-40.
Ah, okay.
The IRS essentially admitted that forcing USS to produce a full Form 5471 was impossible. Revenue Procedure 2019-40 created the concept of the foreign-controlled CFC and the related constructive U.S. shareholder, which we classify today as the Category 5C filer.
So USS in our example becomes a Category 5C filer. They are related to the new Indian CFC through their parent. They only own it constructively, and the CFC is fundamentally foreign-controlled. What actual relief does that 5C designation provide the CFO in Ohio?
It provides a massive reduction in the reporting burden, but it does not provide total immunity. A Category 5C filer is still required to file Form 5471.
They still have to file it.
Yes. They must attach it to their return to alert the IRS to the existence of the phantom CFC. However, according to the sources, their burden is generally limited to identifying information on page 1, Part 2 of Schedule B, Schedule E, Schedule G, and Schedule 1.1.
So they are spared from having to produce the full income statement and balance sheet of the Indian sister company, which the London parent wasn't going to give them anyway.
Exactly. The IRS accepts the basic identifying data and certain high-level transactional data, bypassing the impossible demand for deep financial accounting.
But notice what the relief does not do. It does not relieve you of the obligation to know that the phantom entity exists in the first place. You still have to map the downward attribution. You still have to file the reduced form. Yeah. If the CFO in Ohio doesn't know the London parent bought the Indian software firm, they won't file the 5C form. The form is not substantially complete. The infinite statute of limitations is triggered.
Which brings us full circle to the absolute non-negotiable necessity of the transaction log and rigorous global coordination. A U.S. subsidiary cannot exist in a vacuum. It must force its foreign parent to disclose global acquisitions in real time so the U.S. entity can protect its own compliance posture.
The complexity here is simply staggering. We have covered an immense amount of ground today. Let's summarize the vital, actionable takeaways for you listening right now. What we've discovered is that the categories on Form 5471 are not administrative suggestions. They are the absolute arbiters of your compliance reality. They determine the specific schedules you must file.
Now, we established that correctly assigning these categories and flawlessly filing every single required schedule is the singular path to achieving substantial compliance. Substantial compliance is the only key that starts the statute of limitations clock, protecting your organization from open-ended, infinite liability under Section 6038.
We looked at the mechanics of this system. We traced the residual ghosts of Category 1, proving that the 2017 transition tax EMP is still actively haunting balance sheets. We uncovered the deeply personal trap of Category 2, where individual officers and directors are held liable as an early warning system for corporate acquisitions, and their only escape relies on the perfect compliance of the corporation itself.
We walked through the incremental math of Category 3, demonstrating how the 10% blocks operate like a punch card, forcing a chronological look back that renders static year-end org charts useless. And we navigated the transition from event-driven Category 3 filings to ongoing Category 4 and 5 obligations.
Finally, we waded into the absolute chaos of constructive ownership. We analyzed how the 2017 repeal of downward attribution intended to punish corporate inversions created a net that drags innocent domestic subsidiaries into phantom ownership of foreign sister companies, forcing reliance on Category 5C relief just to survive the reporting burden.
To leave you, the listener, with a final lingering thought, we focused heavily on how downward attribution creates invisible reporting liabilities. I want you to evaluate the perimeter of your own organizational structure.
Yeah, think about your own charts.
If your foreign parent company, or even a foreign individual who owns your domestic startup, acquires a tiny, seemingly insignificant new entity anywhere in the world tomorrow, how many foreign sister companies just became immediate reporting liabilities for your U.S. operation?
Without an airtight, globally coordinated transaction log that maps movements and applies constructive ownership rules daily, you might already be incurring infinite penalty liabilities without even realizing the triggering event took place. The fractures in your compliance aren't going to be obvious. They are hidden deep within repealed paragraphs and incremental threshold blocks.
That's the reality.
The only way to survive the diagnostic muddy waters of Form 5471 is to dive deep into the regulatory sources, map the reality of your organization chronologically, and maintain relentless vigilance over every global transaction. Thanks for joining us on this deep dive into the sources. We will see you next time.